When we talk about artificial intelligence, we often use language that makes it sound weightless. We call it the cloud, imagining an invisible force made entirely of software and code. But that illusion collapses into concrete the moment you look at the physical hardware. Every single query typed into a chatbot. Because of this heavy physical footprint, the primary bottleneck for the technology sector is no longer software engineering. The limiting factor for AI expansion is raw electricity generation. Historically, most projections assumed African nations would simply be consumers in this new market, logging in to use tools developed and hosted in Western data centers. But industry leaders are beginning to pivot toward a different strategy, positioning African economies to physically host the computing infrastructure that makes AI possible. This strategy treats AI's high demand for power as a catalyst, a way to provide the reliable industrial demand needed to justify building out new renewable energy networks. For years, African energy development has faced a persistent hurdle. A country might map out optimal geography for wind and solar generation, but the actual construction of those power plants frequently stalls before a single panel is installed. The central issue is one of scale. You cannot secure the hundreds of millions of dollars in upfront capital required to build a utility-scale power plant unless you can prove to a bank that you have a massive industrial buyer ready to purchase that electricity for the next 20 years. Without that confirmed buyer, high-potential energy projects risk sitting idle, unable to justify the cost of connecting them to a wider grid. In project finance, this role is filled by an anchor customer, a single entity with demand so large and predictable that lenders will approve the loans to build the surrounding infrastructure. An anchor customer changes the math of a solar farm from a high-risk liability into a long-term financial asset. The modern artificial intelligence data center is designed to function as this type of customer. Residential power usage is volatile, spiking mornings and dropping at night. But an AI data center provides a continuous baseline of consumption around the clock. This predictability allows investors to model returns with high certainty, unlocking capital to fund physical construction. South Africa has emerged as a key candidate for this integrated model. The country holds a specific combination of assets that data operators require: dense fiber optic connectivity, a deep pool of technical skills, and geography that yields high returns on wind and solar power. In this environment, the traditional boundary between investing in technology and energy generation is fading. The moment one of these data centers secures funding, it triggers an immediate physical multiplier effect. As this map shows, a single data center necessitates the expansion of secondary systems. It requires new high-voltage transmission lines, utility-scale battery storage, and expanded fiber networks. As these networks expand, they intersect with a rising policy mandate known as data sovereignty. Governments are showing a growing interest in processing sensitive information within their own borders, rather than relying on infrastructure located thousands of miles away. This push for sovereignty strengthens the business case for regional infrastructure, as it points toward a future where domestic data is processed within the borders where it's generated. Institutional capital naturally flows toward markets with clear regulatory frameworks. When a country provides stable energy policy, alongside a clear digital strategy, it reduces the risk for the private investors who fund these large-scale projects. The global AI race is no longer just a contest between software engineers. It is a competition between physical infrastructure ecosystems, and the countries that can deliver the power will likely host the future of the technology.